Hello and welcome to a brand new episode of Mind Over Money, a show where we talk about ways how meditation, yoga, and behavioral science can help you become a better and efficient trader, investor, as well as a better human being. Well, my name is Jita Janand, and today we have with us a very special guest, Rahul Jain, who's a president and head personal wealth at Edelweiss Wealth Management. Well, welcome to the show, Rahul.
Thank you, Shutish. This is my second show with you, Mind Over
Absolutely.
Money, and I really like the series, and I'm really looking forward to this one as well.
Thank you so much, Rahul, for your kind words and your time. Well, today we'll be talking about a behavioral aspect of trading. And so, do you feel that increased usage or increased use of smartphone has also resulted in increased amount of trading? Now, why we say that is the kind of traders who have joined are, especially the new ones, are below the 25 or the 30 age group, and they are pretty tech savvy as compared to us, so we are pretty old school in that respect. So have you seen that kind of difference as well recently?
So I think usage of smartphone has surely increased the overall trading volumes for sure. If you look at mobile phone or smartphone, I think this has become a very integral part of everyone's life. I think the whole ecosystem is something where individual revolves around it.
Correct.
Your office is on a mobile phone, your entertainment is on a mobile phone, your social circle is on a mobile phone. So every time you do anything on this respect, you are on your mobile. So people end of the day are spending so much of time on mobile,
Mhm.
which is obviously leading to increase in volumes there itself. Also, if you look from the mindset point of view as an investor, in terms of trading also, generally there are two type of traders I would say who generally trade in markets. One is that who decide on his own that what I want to buy, whether I want to buy Reliance, I want to sell SDFC Bank, or I want to buy Nifty. And generally what they are looking for after is that they want some data points to finally take a decision on the same.
True.
Now, what is happening because of the advent of apps, etc., the data is available on your mobile, and that allows you to take decision very fast, and that finally that leads to investing that also on the move. If you see some 5 7 years back, while
Mhm.
you want to make those decisions, you have to be in your office, you have to be on your laptop or your PC
Mhm.
or research reports, etc. But now that all data is available on the move, and that data is available on the move, which allows you to also take decision very fast and then execute that trade. So that is one. Other is that there's another part of the community which generally seeks advice from their friends, families,
Mhm.
some advisors. Again, if you have installed an app which is on financial markets, they also send you notifications that this is looking good to buy. So effectively, and also the whole ecosystem, because there are a lot of people who now come and advise on YouTube. There are influencers who people follow. So the whole ecosystem is available on digitally. And when this
Okay.
ecosystem is available digitally, your app is there, YouTube is
Mhm.
there, Facebook is there, WhatsApp is there on the mobile, which allows you to take the advice very fast and execute on the mobile itself. So if you take these two things coming
Mhm.
together, I think the whole behavior is shifting towards trading on the smartphone and mobile. And if you also see the BSE data,
Mhm.
the cash market volume percentage was around 5% in
Correct.
June 2019,
Mhm.
and the latest one is around 19% of the volumes coming through mobile.
Okay.
So that is the type of the growth which we have seen, and that is significant growth. But I think the whole ecosystem on mobile is helping that the
Mhm.
volumes to increase.
Absolutely. In fact, a very good point there you highlighted that the ecosystem is changing, and definitely technology is one big factor behind that change. And when we are talking about technology, so Rahul, definitely, in fact, one good thing or one important thing which you've pointed out is that the whole ecosystem seems to be changing, and yes, technology is behind that change. And when we're talking about technology, we can't ignore social media, and many channels on WhatsApp or you could say Telegram have been partly responsible for spreading false information of guaranteed returns. So, do you think that in this age of social media, where millennials are actually hooked onto these platforms have a role of playing in towards the misguidance that we are seeing? In fact, SEBI has taken action on a couple of these channels recently as well.
So I think it's a very relevant point, and unfortunately, yes, I think that's a issue which is happening. In the previous question, I was just giving you perspective that how this whole ecosystem is helping the trading volumes to go up and also help investors, correct? Because you take advice. But I would say this is the con part of it, where it is the negative part of it, where there is a lot of misguided information, there are a lot of guarantee returns. They also showed like you will build a jackpot in some hours from the market. And I always keep telling to my consumers, my users, my friends, etc., who also show me that, see, this type of research is available. Right. You say that you can make 14%, but he's saying you can make 14% in a week. So I think these information or questions comes to us also very regularly. We have always said that please be aware. Please go after authentic people in terms of advisors, brokerage houses, wealth managers, and take their advice while doing this, because going into such inducements will obviously attract you, but it can also have serious impact on your capital. My sense is delivering such humongous returns or making feel like that there's a jackpot available on investing in equity markets. I can tell you I've been long in the market. Investing in equity markets requires skill. You can absolutely make a great return out of it, but it requires skills, and it is also not as easy what it shows in the social media platforms. So I think users should be, or consumers or investors should be very, very careful about the same, and should not get into such inducements as well.
All right. In fact, now this particular session is largely for those who have just recently started trading, or they might be students, or they're just fresh out of college, or they might be studying at this point in time, but they want to, want to get a bite of equity markets. Now, this question is very relevant for those. Now, should one directly invest in stock market, especially if someone who is, in college or just made an account with discount broking firms? Because now opening an account has become so very easy that it could just be opened, in days, or we would say not even days, in fact, in hours, because of the help of technology.
So I would say that any investor, whether it's a college student or whether he's a investor of a certain age as well, should always, before investing directly into stocks, should understand them well, and should also understand the nuances of investing directly, whether it is understanding about the company, fundamentals, the markets, how the scenario is panning out, growth prospect, etc. So that is there for everyone, irrespective of whether student or an adult or a person who's matured, who's also have amount of money which is significant better than student. For everyone, that is one. But I think it's a very relevant one because of the fact that since you are a college student, you are very young at age, your risk appetite at that would be highest, because you can take risk, and equity market investment is risk. True. So generally what I suggest, because I also have family, people who are in college, and they also keep coming and asking me, should I invest in stock markets right now? So someone who's interested, who's spending time to understand companies and understanding about their fundamentals, knowing that what are the nuances work, what sector is working, not working, if he's someone willing to spend time, yes, he should dabble directly into stocks. There is no harm. But my suggestion is that if you want to put 100 rupees, put 10 rupees into direct stocks at the start, learn about it, because you will require some experimentation. You want to put real money in for some amount, put 90 in mutual fund. And once you learn more and you become more and more confident about the nuances around the stock market investing directly, then you can start moving that money from mutual fund to direct equity. But at a start, I would say, since you are young at age, you can do some bit, but not the whole amount. 10% of it can go, but spend time, learn. And once you have learned about it, then start moving that other mutual fund money also to direct. So once you become confident. So I think you can start for sure, but you can calibrate, but you should put effort on understanding companies, because that is the most important and critical. If you're just taking advice from WhatsApp and then putting money in that stock, my advice is avoid and then put it on mutual fund.
In fact, golden words there from you, Rahul, and I'm sure our viewers take note of that. And let's say if somebody is directly investing into stock market, what are the risks associated with that, Rahul? What do you suggest?
So I think since equity class is one of the highest generating asset class as well,
Mhm.
it is also has risk associated with it because while you're investing in stocks, there are four, five things which you should always be aware or you should know. Like whether this sector is good to invest upon, whether this company is good fundamentally in terms of balance sheet, numbers, etc. What are the growth prospects, corporate governance, who is the management, all are very important and critical. And if you
True.
go wrong, you can lose capital
Mm, mm,
in that sense while investing in the stock market directly. So that is one. Another important risk, which is less spoken, which I feel is important one,
mhm.
is the psychological understanding of markets.
Okay.
I would say that when markets are going up, people are blind to risk,
Mm,
and when markets are going down, people are blind to opportunities. There's a very common saying of Warren Buffett, which also says that when markets are at the top, you should become fearful, and when markets are at bottom, you should become greedy.
indeed.
But generally, people do the opposite.
Yes.
And I say this is more of behavioral, correct?
Mm, mm,
So risk is one is that you should know about the company. You can go wrong on the company,
mm,
but
mm.
also it's about your behavioral. You have the right stock, you have the right company, but if the market is very volatile, are you able to understand the nuances, keep invested for the long term, think about that? I think that is also where people make a lot of mistakes. I would say that a large part of people are still able to pick the stocks well. That is my sense, who is investing time. But where they go wrong is on the whole the behavioral part. When the
Yeah.
markets are going down, they just get out of it. When the markets are going up, they become more and more bullish about it and take larger positions. I
Mm,
think dabbling among these two becomes a too big, large associated risk. And if you're able to do this well, if you're confident around it, I think that in long term you will surely make money out of stocks. But otherwise, if you have challenges around the same, then the
mhm.
suggestion is that you should do something through passive, where expert fund managers who understand both sides of nuances can
Mhm.
work really well.
Absolutely, and definitely, somebody is investing in a stock market, and every young investor has a dream of becoming a crorepati. And can they fulfill this by, let's say, investing in the stock market directly or via mutual fund? Now, I'm sure there's a very frequently asked question to you as well. Many, you could say, a student or a new investor who just recently opened an account. I think this is the first thing that probably they would have in their mind कि वॉस ये हो सकता है कि नहीं हो सकता.
So I say 100% absolutely हो सकता है. If you are following discipline, if you are consistent, this can easily happen. And I'll tell you an easy example. And another thing is that equity is the highest growth asset class, correct?
True, true.
And adding compounding by building consistency and discipline can really give you significant results. To just give you some idea, Kshitij, a 10,000 rupees of SIP
Mhm.
invested for 20 years. Every month, if you put 10,000 rupees for next 20 years,
Mhm.
Nifty has given a return of last 10 years around 13%. If I put at 12% also, this money will become 1 crore in 20 years.
Right.
10,000 every month for next 20 years, disciplined 10,000 rupees every month will become around 1 crore with 12% returns. That market will give you effectively, because I'm talking about last 10 years as well. So it's a very
Mm-hmm.
comparable in that sense. Can make you a crore. Now for a student, for a person who's getting out of college, who's doing your first job, etc. I know 10,000 is a big amount, but 10,000 in the current aspect is also very relative. If you go for a movie right now to the cinema halls, two people, movie cost becomes 2,000, 3,000 rupees this time,
True.
correct? If you go for a dinner to a normal place, 2,000 rupees is easy these days.
True.
So 10,000 out of those, putting in for consistent 20 years every month, don't think too much, that will become around a crore. So it is in that sense, if you're consistent, you're disciplined, you're not too wavery, this asset class will create a crore pati for you. And if you are able to add this amount by saving more or earning more, etc., then your crores can keep adding up.
True.
So in that sense, equity really plays well if you do it for long term, because the whole compounding impact has a significant exponential impact on the final outcome.
Absolutely. In fact, consistency and discipline are two keywords for investors. And yes, it is possible to become a crorepati, provided you have that kind of temperament to take you forward. Well, on that note, thank you so much for your time, Rahul. And well, that's all for now. But do stay logged on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time, sir.